Smothers, CEO and president of RDS Wealth. Dale, welcome to the show.
Good to be with you, Ashley.
So we're about 30 minutes away from today's session. What are you going to be following most closely?
Well, the main event today, Ashley, is Nvidia's earnings. We've seen a constant back and forth, what I would call maybe a tug of war since December in the market. Every run up is sold. Every drop in the market is bought up. We've seen this support and resistance trade take place since December. Nvidia itself has the potential to help us take the next leg higher. That is what we're focused on today if we were to put a pin on one thing in particular.
All right, what will you be listening for during those earnings?
Yeah, we've got to see not only strong earnings, as we've seen, tech companies specifically come out with surprises in their earnings, yet be sold either due to forward guidance or spending on infrastructure build out. I need to see a strong earnings report. I need to see good forward guidance, which I don't think Jensen Huang ever really disappoints us in that respect. And I would like to see a little bit of proof that this expense that we see in AI is starting to generate profit. No longer is Nvidia priced for perfection, Ashley. It is now priced for proof. And if Wall Street gets that proof, I think it takes it to the next leg higher. You look at Nvidia specifically at some of its lowest PE rates that we've seen in like 5 years, roughly. This type of trade has allowed Nvidia to grow into its current valuation. I think it belongs at around 225. If we were to put a price target on Nvidia, we got a little bit of ways to get there. So if this earnings comes out with a surprise, I think it takes it to its next leg higher.
And given its market capitalization, what effect could its earnings have on the larger market?
It definitely could drag that AI trade higher for sure, Ashley. That's one of the things we're looking at. The AI trade has certainly cooled off, but the good news is we've seen this rotation into household names, dividend-paying names, consumer staples, for instance, have been a benefactor of this trade, this rotation from tech into the broader market. Nvidia specifically, due to its market cap, could take this AI trade to its next leg as a whole, but at the same time, the opposite could also occur. If Nvidia comes out and doesn't give a stellar report, we could see this put even more ice on the AI trade, which is not a good thing for the broader market, certainly not a good thing for those tech-minded, growth-focused individuals out there.
All right, and Dale, yesterday, President Trump's 10% global tariff went into effect. How do you think the tariff developments will impact corporate America's decision-making?
I think the courts had it right, Ashley, when they called it a mess. There's a logistical nightmare that awaits over the next 3 to 6 weeks. Perhaps we could hear whether or not there's going to have to be a repayment of these tariffs that were collected. If we focus on that alone, though, if logistically there are quick repayments to corporations, that could be a tailwind, almost a tax return is what we're calling this, a tax return to companies that have paid this unnecessary tax perhaps, or maybe an illegal tax. I will put a little bit of a twist on this, though. I don't think that is quite settled just yet. I think it revisits, the Trump administration revisits what they're going to do with these tariffs, how they're going to employ these tariffs, and how they will continue to use tariffs as a tool on the global trade spectrum. And clearly, the Supreme Court doesn't like the way that IEEPA was handled, but I don't think that's the only route that the Trump administration has. So the writing is still being done there. That story is not done. And when it is told, it could either be a really good thing for the market, or it could just cause even more turbulence in the market.
All right, Fed Speak is on the agenda today. We're going to hear from 3 Fed presidents from Richmond, Kansas City, and St. Louis today. What are you going to be listening for?
Clearly they have some data that is a little bit outdated. It is certainly mixed. It's a mixed bag of data. When I look at trueflation, I think it's time to act. Trueflation is the measure that we are looking at right now that we want to keep. At the very least, we want to make sure that we're not entering into a deflationary environment. I think that you've got a strengthening labor market. It's certainly not falling off the cliff. Clearly, if you lose your job, we're in a depression in your perspective. If your neighbor loses their job, we're in a recession. But the data shows us that the labor market's not falling apart. And with that in mind, the labor market being okay, I don't think that we should be focused as much either on inflation. I would like to see the Fed act sooner rather than later with a rate cut. Again, that is a mixed bag when they look at their data. They have a lot of hard decisions to make, and they're walking a tightrope for sure.
Use the term trueflation. Can you break that down for the viewer?
Yeah, so essentially trueflation is a measure of the actual inflation, and typically trueflation is a little bit of a leading indicator of what the CPI is going to show us in 3 to 6 months. We've seen trueflation hit some really nice levels here. As a matter of fact, trueflation data is showing us that inflation is growing at less than 1% currently. Now, that's not what the CPI says, and that's what the Fed is looking at, is the CPI. But if we look at trueflation, we see that the prices are not rising nearly as high as they once were just a year ago. And, you know, what we've seen in price and affordability was front and center with Donald Trump's announcement, or his State of the Union address last night. This affordability crisis started in 2022, 2023. He has now taken this affordability crisis front and center and put it right in front of American consumers, which we're feeling at the grocery stores. We're feeling whenever we go to buy a house or buy an automobile. The American consumer has to realize that we can't really get rid of what has taken place in inflation. Once it's happened, it's happened. It's hard to make those prices go backward. The least we can do is try to not make them rise nearly as fast, and with that, put into some sort of a administrative agenda to rise or raise the wages of American workers. So if we can see wages raise and inflation stay still, 1%, 1.5 to 2 max, we start to see these prices feel like they're coming down, when in reality, American workers are just making more money. So we've got to keep an eye on inflation, but I don't think that we're at the point where we should be concerned with interest rates in the effect of potentially making inflation come back. This is the big dilemma that the Fed is facing right now. As you know, Ashley, if they raise or lower interest rates, they're afraid that it will affect inflation. The reality is, I don't think inflation is on the table at this point. I think that is under control.
All right. Thank you, Dale Smothers, CEO and President of RDS Wealth, for joining us on NYSE Live.
Absolutely. Thank you, Ashley.